I think that discussion around the fiscal rules and whether to loosen them, whether to rethink the targets, whether to change the pace at which countries must adjust, that type of thing. I think that's going to be a really important thing to watch out for, to see in terms of the economic outlook for the Eurozone, is how much pressure is there going to be on governments to tighten fiscal policy.
Welcome, everyone, to another episode of Inside the Markets presented by StockPulse.com. We are honored to be sitting down today with Frances Coppola, independent economist. Thank you so much, Frances, for joining us today.
Pleasure.
Let's talk about what's going on in the banking sector in Europe, especially as it relates to interest rates. What do you see on the ground in Europe?
Well, I'm in the UK, as you possibly know. So yesterday, the Bank of England raised interest rates by a tiny, tiny little amount. It was like 15 basis points. Not enough to make a material difference to anything real out there. It might trigger a tiny raise in mortgage rates for people on the standard variable rate or on a tracker mortgage, but it's going to be like £10 a month. Which for most people isn't going to make a serious dent in their household finances. It's not going to make a great deal of difference to businesses. In fact, it's not going to make much difference to anyone at all. It mainly seems to have been for signalling effects, really, to say, when we say we're going to raise rates, we mean we seriously are going to raise rates if we think it's justified. So here's a taster, here's a shot across the bows. And that's not a bad message to be sending to markets that haven't had any serious interest rate rises for a long time, and a lot of chatter about we'll never be able to raise rates and they'll never raise rates in response to inflation, and inflation will get out of control and all the rest of it. So I think it's mainly signalling effects. It's about saying we are not going to let inflation get out of control. The bank's argument, the letter that the governor wrote to the chancellor, talks a lot about oil and gas price rises. That's gas as in natural gas, which in the UK feed through into fuel price rises, what we call petrol, and energy price rises for households and businesses. And that is a major driver of inflation at the moment. It's obviously global conditions, and it's affecting economies all over the world. In Europe, in America, as well. The UK is not unique in this by any means, and it's difficult to see what difference raising interest rates would make to oil and gas price rises. So I think it's not really about that. And the other thing they talked about a great deal was base effects, particularly in goods prices, where we had very large falls in goods prices last year, and now they're rebounding. We are actually seeing goods price rises, which feed into inflation, but they're because of the falls before. So they're really just rebounding to where they were before. So we have to be careful about things like that, and that there's a few tax rises and things like that involved as well. Inflation is a complex phenomenon, but the one thing that the bank did highlight, and the reason for the interest rates rise, was a tight labour market. And they said if it persists as tight as it is now, then in, say, 18 months' time, we could see inflation expectations drifting up again. And that potentially would feel more entrenched inflation than we're seeing now. And that seems to be why they've raised interest rates. There is similar thinking in the United States, I think, with a little more justification, I think, because the US's stimulus has been much more extensive than anything in Europe. And I think the risk of entrenched inflation is much greater there. It's fair to say also the recovery is a lot better. So there's definitely a relationship between, are you prepared to take risks with your monetary stimulus and your fiscal stimulus as well, to trigger fast growth and help your supply side recover and live with the inflation. I think the message from the UK is no, we're not prepared to live with the inflation. The message so far from the Fed is we're watching it, but we think we're prepared to live with it for the moment. And the message, interestingly, from the ECB is perhaps the most interesting of the lot, where Christine Lagarde yesterday basically said we're not expecting to raise interest rates in 2022 at all. We're going to taper off our pandemic purchases a bit. They had a kind of special version of QE, which was specifically for the pandemic, and they're talking about tapering those off a bit. but they're certainly not raising interest rates. So in many respects, they're possibly the least hawkish of the central banks. And that reflects actually a worsening economic outlook for many parts of Europe, including, importantly, Germany, which has been the powerhouse of the Eurozone, particularly for a long time now. And when Germany catches a cold, the rest of the Eurozone tends to get something rather nastier.
What do you see happening in Germany in 2022 in terms of the economy?
I think an awful lot depends now on what happens with COVID. Germany's outlook is not good. The PMIs were not good. It was suggesting some kind of contraction in the short term. And if the COVID wave really proves worse than expected, then we could see Germany going into another COVID-driven recession. And that would mean, I think, a recession rebounding across the whole of the Eurozone, particularly if the new wave of COVID also rippled out across the rest of Europe as well. So at the moment, I would say, as the IMF puts it, the risks are tilted to the downside.
You mentioned that the economic recovery is better in the US than in the UK. Could you speak to the situation in the UK in particular? What's the outlook like there economically, especially as it relates to things like the job market?
The job market, we have a lot of vacancies at the moment. So the labour market is quite tight. But we are going into new COVID restrictions, which are already hitting hospitality. So I'm going to expect those vacancies to fall significantly over the winter. So we are going to see it's interesting to see how that will flow through into unemployment, or whether it will flow through into, reduced participation rate, and whether the Chancellor comes up with additional support, whether he reopens some form of the furlough scheme, which actually helped to keep unemployment down during the previous waves of COVID. We've kept people attached to their jobs and essentially paid them not to work, rather than them losing their jobs and ending up unemployed. There's a slightly different strategy from that used in America, where they very much more used the unemployment system to support people much more than we did. So in a way didn't suffer the distortion in unemployment figures that we did here. So I'm expecting to see the labour market actually loosen quite a bit if we end up with more COVID restrictions, if hospitality takes the sort of beating that is already beginning to become apparent. We're already seeing, Christmas dues being cancelled and things closing down voluntarily. The government keeps insisting don't cancel your Christmas parties, but actually people are cancelling them. And I think because they think if we go to these Christmas parties, there's a good chance we'll catch COVID, and then we won't be able to spend Christmas with our loved ones. And it's actually quite a serious dilemma for many people, I think.
Are you seeing negative interest rates crop up across Europe over the last couple of years?
We have negative real interest rates already. By the time you take inflation into account, real interest rates are negative. Pretty much everywhere. But you're talking here about nominal interest rates. And I think you should remember the ECB already has negative nominal interest rates on deposits. It's managed to avoid having negative nominal interest rates on its lending rates, but they're effectively zero. Again, it really depends on the path of the economy over the next few months and over 2022, and the effect that this latest incoming wave of COVID has. If we do go into further draconian restrictions, then negative interest rates will be back on the agenda again as a possible policy response. When you're shutting down part of the economy, one of the things that takes a beating actually is credit. People don't borrow. So you do start to wonder what on earth the effect of reducing interest rates into negative territory would be. And if you are also stopping people from spending, which is the effect actually of COVID restrictions, is to reduce discretionary spending, then in a way taxing people on their deposits when they can't actually spend them meaningfully just seems more than slightly unfair. So I would rather they looked at other ways of supporting the economy during COVID restrictions. And I think all the action really should be on the fiscal side with targeted support schemes for people and businesses, so that you can come out of you can stay alive during the restrictions and you can come out of it quickly again afterwards. We kind of did that pretty well before. I would like the emphasis to come off monetary policy, because I think monetary policy at the moment, the main job of central banks is to support whatever they think their governments need to do.
Can you speak then to the policy of the ECB in terms of tapering the pandemic stimulus, and they're not focusing on doing that throughout 2022? What effect might that have across Europe?
Well, the ECB has got itself into something of a bind, but then it has been a bind that it's been in really ever since 2012 with the Whatever It Takes, when it created an expectation in the markets that it would never allow sovereign spreads to blow. And we saw that little wobble when Christine Lagarde first took office, when she said controlling spreads is not our business, and everybody went and we suddenly started to see spreads blowing out again, and the ECB suddenly had to go, oops, that wasn't what we meant. So given that, I think tapering purchases is going to have to be done extremely carefully, because we don't want sovereign spreads to be widening. We don't want the kind of resurgence of the euro crisis that I think people have feared, and countries starting to get, countries like Greece, for example, starting to get into sovereign distress. It was rather worrying that yesterday, despite a clear statement from the ECB that they had some plan, that with the winding down of the PEPP, they still had some plans to soften the impact on Greece, which of course has been excluded from QE. Greek spreads still widened by 10 basis points. So obviously there's some worry in the markets that the ECB might not do whatever it takes to keep sovereign spreads under control.
Why has Greece been excluded from QE in Europe?
Historically, it's because the ECB early in the aftermath of the financial crisis and the Greek sovereign debt crisis, the ECB bought rather a lot of Greece's sovereign debt. Now, QE is done according to the capital, what we call the capital key, which is roughly speaking the contribution of the sovereign to the ECB's capital. And Greece, being a small state, contributes a fairly small amount, and it had the quantity of bonds that the ECB had bought had pretty much already eaten up the capital key. So it was excluded from QE for that reason, just simply on the grounds that ECB already held too many of its bonds. And that has been, there was a waiver for a long time, for a while, which was kind of before the ECB started doing QE, but there was a waiver, at least on emergency liquidity assistance for banks, which kind of enabled the ECB to do more. But it has, to my knowledge, never flown through into allowing Greece to be included in QE. So the ECB has been finding ways around that. And one of the big helpful factors in the last 2 years has been the fact that Greece was included in the PEPP, and it has eased its fiscal situation quite a bit. I think Greece would have found it very difficult to respond to the pandemic if it hadn't been for that.
Could sovereign debt crises crop up across Europe and other countries?
Oh, yes. Well, I mean, the 2012 crisis was more than just Greece. It was Italy, Spain, Portugal, Ireland, of course, famously, after the banking crisis, although Ireland's situation is very much better now. We do have quite a lot of highly indebted sovereigns in the EU. And we should remember that when a sovereign doesn't produce or manage its own currency, then its options for controlling that currency are its debt are quite limited. So, for example, the Bank of England can, if necessary, buy up all of the UK's sovereign debts on secondary markets and control the yields on sovereign debt that way. It might take a beating on the sterling markets, because investors might decide to punish the currency instead. That's always a risk. But in the Eurozone, the central banks can't do that. So there is always a risk that investors will dump Eurozone sovereign debt. And the pressure then is on the ECB to act as a buyer of last resort. And that was kind of what Mario Draghi's Whatever It Takes established. And it is all about keeping the euro together, stopping the euro from fragmenting. That's why we need to keep the ECB has got itself into a corner, really, where it's in a way committed to controlling sovereign spreads, because if it allows the spreads to widen too much, then there is a risk of sovereign debt default and euro exit. And if that happened to Italy, then it would be almost pretty much game over for the euro. So they don't want to go there.
Have you followed the situation in Turkey at all regarding increased prices, inflation, bread lines?
Oh, yeah, Turkey. And we've been discussing that on Twitter this morning, actually. There's some fairly bonkers things going on there. It's quite hilarious because it's very high inflation, as you know. Partly that's because of global conditions, and partly it is because of the combination of a fairly original fiscal authority, shall we say, a captive central bank now, and some very strange monetary policy. So we are seeing rising inflation and a collapsing exchange rate, and the central bank is cutting interest rates, which is a very odd thing to do. And unsurprisingly, markets are responding to that by dumping the currency. So the lira is going into free fall because the reaction function of the central bank is just all wrong for the situation. They're looking for some action that will bear down on inflation and stabilize the exchange rate. And they're seeing the opposite. And they're seeing the opposite because the central bank is captive and is doing what Erdogan wants, where he said for many years that he believes that that high interest rates are inflationary, and he's cutting interest rates in response to inflation. So we have, fiscal dominance by a dictator with some very strange views. History shows us this doesn't tend to end well. So I think that's roughly what's going on in Turkey, really. The central bank is also not helping matters by intervening in foreign exchange markets, because it's got really quite limited reserves. In fact, there is a view that says it hasn't got any reserves and it's relying entirely on credit. Basically stiffing the banks to prop up the exchange rate, and by implication stiffing people's savings by propping up the exchange rate, and that doesn't tend to end well either. So I suspect that unless we see a volte-face from Erdogan fairly soon, we might end up in full-blown FX crisis. We're not there yet, but it's kind of heading that way, which isn't good, given that this is already a country with really some really quite serious domestic problems.
How are they getting it wrong there in terms of monetary policy? What should they be doing, in other words?
Well, conventional wisdom would say they should be raising interest rates. Now, the problem really is raising interest rates is always a little bit of a double-edged sword, because on one hand, if you raise interest rates, it does attract investors into your government debt and your currency. But on the other hand, it makes the ability of domestic borrowers to service their debt more difficult. So there's a bit of a fine balancing act here, and there is an argument for at least partially allowing the currency to take strain. So rather than doing draconian interest rate rises, such as Argentina had, for example, and had interest rates of 60% at one stage. Turkey is saying, no, we'd rather let the currency take the strain. And there is an argument for that. But if you completely trash your currency, then you end up with borrowers not being able to pay their debts anyway. So it's a little bit of a fine balancing act here. But right now, I would say that the signal that they should be giving to markets is an indication to raise interest rates enough to get inflation under control and to stabilize the lira.
Are there any countries in Europe that face or could face something similar to what we've seen in Turkey?
Well, really, in theory, any country that has its own currency and its own central bank could act in the same way as Turkey. So you might see a similar kind of action from, say, Poland. You wouldn't see that from Eurozone countries because they're not producing their own currency. They don't have the ability to manage monetary policy in that way. So they are much more reliant on what the ECB does. So there, it's more a question of whether a government can manage to just borrow excessively and then end up unable to pay it. And we've seen that played out in the Eurozone before. And I think it's worth distinguishing between those two groups of countries, the countries in Europe that are members of the Eurozone that don't have their own currency, and also some countries like San Marino that aren't members of the Euro but use the Euro, or are pegged to the Euro, like Bulgaria, which is a candidate country for the Euro, but it's not actually a Euro member yet, but it has a currency board with a hard peg to the Euro. Denmark, too, has a peg to the Euro. So those are countries that all have a sort of limited control of monetary policy, really, and they have to maintain, and in the case of those with pegs, they actually have to maintain their monetary policy in such a way as to hold that peg. And then there are other countries like Turkey, like Poland, like the UK as well, which have their own currencies, their own central banks, and really can choose their own path to hell if that's what they choose. And I'd rather hope that they don't. But, sometimes I think things just get out of control, really. And I think sometimes countries reach a point where whatever they do just looks bad. And then it's the question of, have we chosen the right options? And I would say the best thing to do is don't get yourselves in that position. Pay attention to what the markets are telling you, because one of the benefits of market finance of governments is actually that you do get some feedback from the markets about how external people see your country, your economy, your politics, and that does affect the value of your currency and the value. You would then take the beating on the currency. You can't escape from markets ever. There's always a market signal to a government.
Could you speak to the situation in Germany and where you see that headed in 2022, and how bad could it possibly get?
One of Germany's big problems. This is going to sound bizarre because we've always seen this as a strength before. But actually, in the present situation, one of its big weaknesses is actually it's very dependent upon its external position, on its trade surplus. And we have a world where international trade is really quite seriously disrupted. And so a country that is dependent on external trade, as Germany is potentially going to take quite a beating economically, because it depends so much on its external earnings. So I think that Germany could find that its production, the production side of its economy, suffers for a while, really, until the global economy recovers. That said, the fact that it is externally driven, it does have this very strong production sector, could mean it could recover quite quickly if it can steal the advantage as supply chains and other countries start to recover as aggregate demand returns internationally. So, but certainly in the short term, in the course of 2022, if we do get this major wave of COVID, which it looks as if we are, then I think we're going to see further disruption to international trade, and that will affect Germany quite badly, I think.
Do you have a sense about the new government in Germany and how they will govern?
I rather get the impression from them that they are hoping to roughly continue with what the previous government did. Olaf Scholz doesn't exactly look like a new broom to me. They appear to have chosen him because he's kind of, in many respects, kind of policy-wise and even in his approach to things, sort of quite similar to Merkel. So I'm not convinced that we're going to see any great changes in the approach to government in Germany, and I don't really get the impression that the Germans really want a great a great difference in approach, particularly economically, because let's face it, it's been successful. So why would they change it?
What should we be looking at in terms of Europe in 2022? What should people be keeping an eye on?
Well, as ever, the signalling from the ECB. But I think one of the most interesting developments in Europe, and I rather hope they pursue this, is actually what they do with the fiscal rules. There's quite a lot of discussion around that because the fiscal rules do mean that, absent exceptional fiscal stimulus, there is pressure on governments to restore their fiscal position very, very fast after the pandemic. We've had a kind of suspension of fiscal rules during the pandemic, but there is a debate over how quickly governments should return to the normal Stability and Growth Pact rules, the 3%, not more than 3% of deficit across the cycle, and 60%. Lots meets that at the moment, and none of them do on the deficit either. And there is pressure from what we used to call core countries, kind of northern countries that are richer, for poorer countries to return to that really very fast. And that's going to mean quite draconian fiscal adjustment in the next year or two. But there's quite a lot of pushback saying actually that would be really bad, not only for those countries, but for the Eurozone generally. Because it has, the pandemic has been exceptional. It's even more exceptional than the financial crisis was. And we know from the history of the Eurozone crisis that trying to force governments into that kind of a fiscal adjustment too quickly has huge welfare implications, for one thing, for their populations, but it also has quite bad effects on the Eurozone economy. I mean, the ECB has spent a decade trying to prop up the Eurozone economy and frankly failing, not coming close to its inflation target a lot of the time, because it's got this constant fiscal drag from the fiscal rules that are too tight. They may make individual sense within an individual country, but when you put them all together, it adds up to concurrent fiscal tightening across the entire Eurozone, all at the same time, and with very little offsetting it. And that makes for quite a drag on the Eurozone economy. So if they want a vibrant Eurozone economy, particularly in a world where international trade might be disrupted for quite a while, so their ability to pursue an export-led growth policy might be quite limited. I think that discussion around the fiscal rules and whether to loosen them, whether to rethink the targets, whether to change the pace at which countries must adjust, that type of thing, I think that's going to be a really important thing to watch out for, to see in terms of the economic outlook for the Eurozone, is how much pressure is there going to be on governments to tighten fiscal policy.
We've had the honor of sitting down today with Frances Coppola of CoppolaComment.com, an independent economist whose work you can find at twitter.com/Frances_Coppola. Thank you so much, Frances, for joining us today.
It's been a pleasure.
And thank you everyone for listening to StockPulse.com's Inside the Markets.